He said he got his butt kicked during the pandemic, but the situation has certainly changed this year. His global value strategy fund is up 48% this year. The S&P 500 down more than 20% over that time. I asked him about the thinking behind his strategy and why many value funds have taken a leg down in June.
June is actually one of the first, not horrible, but one of the first bad months we've seen for value in a while. Thank God we spend a ton of time with our clients showing them post the tech bubble peak. And I don't want to overstate it. No period's exactly the same, but I think they kind of rhyme. Value made a ton of money over the next 4 years. It was highly, as the geeks would say, nonlinear. It didn't make 1 divided by 4 years worth of money every day. It had big comebacks, and then whatever forces on the other side disagreed. So you shouldn't do this expecting to have a calm life. But the give back is not that huge this month. And why are we sticking with it? That spread I love to talk about, the value spread, had dipped below the tech bubble maximum, but the June trade-off has left us back at tied with the tech bubble. I kind of don't count COVID. It did occur. I don't mean you can remove that from the record, but I don't think that's something you, like you said, want to plan on your pandemic risk all the time. So we're sticking with it because, A, we always like some value in the portfolio, and we do like more when it looks very, very cheap. And it's basically tied. It's way off its highs, but the highs were so high, it's tied with the tech bubble. I still think relative prices are crazy out there. And, this month, the
relative prices between value and growth?
Yeah, between value and growth.
Growth is still too expensive.
Growth is still too expensive.
Even though some of these tech names have been shellacked.
Some of them have. I actually just recently wrote a piece on our website talking about how value is not all tech versus everything else. In fact, and this gets a little geeky, but the way we do value, and we wrote our first paper on this 27 years ago. I'm starting to say a quarter century. I think that sounds more elegant and mature. But that we don't believe value or many other measures do a great job of betting on industries and sectors. We think they do a better job within industries and sectors because it's more apples to apples. It's a higher risk-adjusted return. You can make a lot of money on sectors, but you can also lose a ton of money. So if
you're not talking about going long energy and short tech?
No. For us, we're looking for the cheap and the other things we believe in: profitability, low risk, momentum.
Can you give us some examples, some names?
Okay, but first, I have to give you huge caveats. Everyone at AQR is terrified when I talk about specific names because it's not what we do. As quants in a global market neutral portfolio that's not just value but is multi-factor, we might have 750 names long, 750 names short. Most of the time, I don't know the specific names. And that sounds bad. If I was a Graham and Dodd manager with 15 stocks, that would be terrible. But we're not betting on one name. We're betting on the average characteristics: cheap, profitable, good momentum stocks outperforming. But because I knew I was coming on TV. So I'm a little terrified that we'll do well, but whatever I mention here will do horrible. So we have to make an agreement. You're not allowed to come back a year later and say, you recommended this.
You pounded the table on Meta. Is Meta value stock right now?
Meta, I don't call it Meta. I call it Facebook because Meta's a stupid name. But both Meta and Amazon are generally liked by our process now. They're cheap versus their peers. Again, we do industry comparisons. They're not always perfect. Meta is a social media and whatnot, and Amazon is internet retail, I think is the official name, even though that doesn't capture web services. They're never perfect mappings. But they both look good on a combination of, I'll do a simplified version of our model: value, profitability, and low risk investing. The mix is a little different. Amazon is actually pretty good on all three.